Welcome back. Well, one of the most interesting topics in financial markets this year has been the emergence of the inverted bond yield. It's not something that happens very often, but when it does, it's certainly something we should make note of. So I thought it might be helpful to take a look back into history to see what other inverted bond yield curves look like and how markets behaved accordingly. Quick recap, a normal yield curve occurs when we have a short-term maturity bond, like for example the 1-month, 2-month US Treasury bonds pay a smaller interest rate than the longer-term bonds, like the 10 or 20 or 30 year. And if we were to draw a line across the top of these yields, we would see an upward sloping line. This is called a normal yield curve. It occurs during quote-unquote normal economic conditions. A flat yield curve emerges when we have the same or a very similar yield curve across many different maturities. So for example, the 1, 2, 3-month yield is very similar as the 5-year bond, which pays a 2.44% yield. An inverted yield curve emerges during a period of economic stress. When traders, for example, are selling the 1, 2, 3-year bonds, the short-term bonds, in lieu of buying the longer-term bonds like the 10-year. Now there's an opposite correlation or opposite effect which we see here. When bond yields go up, the price of the bonds goes down. So when we see the 1-year bond at a 408, the bond yield is at the high, but it actually means the bond price is at the low. In this case, traders are buying the near-term bonds, the 1-year bond, and not as much the 10-year bond because they're very nervous about the long-term, future. Now, taking a look to the year 2000. Number one, we have an inverted bond market that begins. The green line is the 1-year bond yield. The purple line is the 10-year. Notice that the green line drifts above the purple line, the 10-year, while the S&P 500 is right near the highs. This occurred right over here, July 20th, 2000. The 1-year bond pays a 604. The 10-year pays a 601. The S&P 500 is at 1485, and that represents a 0.03 or 3 basis point inversion, where the 1-year bond at 604 is 3 basis points above the 601. In this case, the 10-year bond inversion begins with a weak 1-year bond. Number two, the inverted bond market actually ends. That's when the purple line, the 10-year, drifts back above the green line, the 1-year. Notice stocks started to come down, but not a lot yet. On January 3rd of 01, 504 is the yield for a 1-year bond. The 10-year pays a 514. The S&P 500 is at 1306. That represents a 10 basis point spread, meaning that the 10-year is 10 basis points above the 1-year. That's when the bond inversion ends, and the 1-year is a little bit below the 10-year. Now, going back, number three. Stock market bottoms out. The S&P 500 crashes and hits a low around 2003. Notice the green line falls very, very quickly. This is the anatomy of a stock market crash. When the green line collapses, that's the 1-year bond. The purple line's a 10-year bond. The yield also goes down, but not as much. What's happening here is traders are buying the 1-year, and they're buying it so much that the yields are going down. Now, they're buying the 10-year, but not as much. They're more fearful about the 10-year outlook than the 1-year. Number four, September 2nd, 2003, the 1-year bond pays a 139, the 10-year pays a 461, while the S&P 500 is at 1039. That represents a 3.22% spread between the 10 and 1-year bond. Notice it goes from 265 to 322. The spread widens. And we can see here, as the stock market begins to recover, the purple line goes up while the green line kind of stays put. Because traders are now so optimistic about the future that they want to buy the 1-year bond. They're selling the 10-year bond. The yields are going up on the 10-year, but they're buying the 1-year. Fast forward to 2007. It's the same pattern. Number one, the blue line, which is the 1-year bond, that drifts above the red line, the 10-year. That's as the S&P 500 actually is still going higher, 2006, 2007. Number two, the inverted bond market ends, where the red line crosses back above the blue line. The 10-year crosses back above the 1-year. In this case, we can see here, June 6, 2006, the 1-year pays 503, the 10-year 501. That's a slight inversion of 2 basis points. That's when the S&P 500 is at 1260. On August 9th, 2007, the 1-year bond yield drops to a 474 and the 10-year drops to a 479, while the S&P 500 actually goes up. That's a 5 basis point regular, not inverted spread, I should say, but it's so close, we call this a flat yield curve. 474, 479, it's about the same. That's when we see over here. Again, the inverted bond market ends. Those two yields are very close together, and the S&P 500 is not really going down. It's actually went up a little bit from the time the inverted bond market began. But then number three, the stock market crashes in 2008. The spread widens. The 1-year bond drops very aggressively. And then the red line drops, that's a 10-year bond, drops, but not as much, not nearly as much. We can see over here, February 2nd, 2009, the 1-year bond drops from 474 to 0.51. The 10-year drops from 479 to only 276. The S&P 500 drops from 1497 to 757. That's a stock market crash. And the spreads widen. Technically, it's a normal yield curve because the 10-year pays a higher yield than the 1-year. But I should note that in the year 2000 and also in the year 2007, both of these charts have something very important in common. The yields are declining. The 1-year drops aggressively in 2007. In the year 2001, the 1-year drops aggressively. It's the same pattern. And again, when we start to rally, the 10-year rallies hard. In the year 2003, the purple line also rallies very hard. It's the same pattern. Now, notice the percentage moves. When the bond market inversion comes to an end, that's when the 1-year drops from a 604 to a 504. That represents a 17% decline. In the year 2007, when the inversion ends, the 1-year drops 6%. The 10-year bond in 2001 drops 14% versus 17%. It drops less. In the year 2007, the 10-year bond drops 4% and the 1-year bond drops 6%. It drops less. The 1-year bond drops a lot more, or a little bit more at this point. When the stock market crashes, the 1-year bond drops 72% versus a 10-year drop of 21% in yield. When the stock market crashed in 2008, the 1-year bond drops 89%, the 10-year only drops 42%. The stock market drops 49% in that period of time. So the anatomy of the stock market crash is the 1-year bond drops a lot, the 10-year bond drops less, the stock market crashes. And then finally, as the market starts to recover, the 10-year bond yield, or the 1-year bond yield, I should say, doesn't really go up. It's actually down 2%. The 10-year bond goes up 13%, quite a bit more. The stock market goes up 24%. In 2009, the 1-year bond yield goes down 4%. Just like in 2003, it goes down a little. The 10-year bond yield goes up 13% in 2003 and 27% in 2009. It goes up a lot more. And the S&P 500 goes up 33% during that period of time. Notice the duration as well. We have 167 days which transpired between the beginning of the inverted bond yield and the end of the inverted bond yield. The bond yield inversion lasted 167 days in 2000, 2001. In the year 2006-07, the inversion lasted for 429 days. Then we have the stock market crash. That lasted for 729 days in the year ending in 2003, and ending in 2009, it lasted for 543 days. This is the longer period of time of this entire cycle, is that actually that huge downturn. That's when 1-year bonds crash, 10-year bonds crash. Now we say the 1-year bond, we're talking about the yields. The bonds are actually going up. And then finally, during the recovery stage, as the 1-year bond really kind of goes down a little bit, the 10-year bond goes up more. We have 243 days for that to take place in 2003 and 150 days in 2009. Now, present day. Remember in the past, we had the inverted bond yield ends, and then we see the spreads widen and widen further. But both yields are declining, especially the 1-year bond. In 2007, it's the same pattern. The inversion ends, and then both lines are declining, but especially the 1-year. It's the same pattern. What's different? Starting January 2022, the blue line is a 10-year bond, the red line is a 1-year bond. We have a normal yield curve, the 10 is above the 1. All of a sudden in July, and we have a choppy S&P 500. It's not a fast move. Remember, in 2007, the stock market actually went up while the inverted bond yield curve existed. So this is not a period of time we normally expect to see weak stock markets. Not yet. But in 2007, when we had the inversion, notice the difference. The red line's a 1-year bond. It continues to move higher. The blue line is a 10-year bond. It continues to move higher. That's different. Notice during the inversion, the yields are flat with a slight tendency to go down. In the year 2006 and 7, during the inversion, the yields are flat with a slight tendency to go down. Present day, the inversion, off to the races. They cannot stop going up. Now, we can analyze this from a fundamental point of view, and we look at the Federal Reserve that is continuing to raise interest rates to fight inflation. In the past, we could argue that the Federal Reserve was a lot more sensitive to stock market woes, and therefore they started to cut rates more aggressively. There's also a further expectation of higher interest rates through the end of 2022 and possibly 2023. The bond market's moving under the anticipation of the Federal Reserve and their future activities. So we don't know yet how this is going to play out. But where we are now, the 1-year pays at 307, the 10-year pays at 296. We have an inverted bond market. Essentially, we're still at stage 1. In the year 2000, we were in stage 1. In the year 2006, we were in stage 1. The bond market is still inverted. Remember that the stock market did not collapse until the inversion went away. And then the 1-year bond started to travel much, much further down than the 10-year did. So a 72% decline in the 1-year bond, an 89% decline in the 1-year bond. That's in 2003 and 2009, respectively. But we're not even close to being there yet. So it's going to be very interesting to see. One final note. Take a look at the black line or the black area chart. That's the 10-year bond. This goes back to 1990. And then we have the blue line, which is a 1-year bond. Notice the black line is above the blue line. That's a normal bond curve. The 10 is above the 1. The red histogram bars that drop down here show us those moments in time when we have an inversion. That's when the blue line was just above the black line. This is in the year 2000, 2001. 2006, 2007, we had another inversion. Those inversions were about 0.5% or 50 basis points. But we should note right now, the inversion on the 1-year to 10-year is much more drastic. This is in July, 307 to 296. But if we were to look at current rates, we would see over a 1% inversion between the 10-year and the 1-year. So in this case, we see a 50 basis point inversion in the year 2000, 2007. We have a 100% or a 1% inversion in the year 2022. That's a much deeper inversion. It means that the 1-year bond pays a significant amount, actually double the amount that it paid in 2006 or 2000 versus the 10-year. So this is a much deeper inversion. I don't know yet what this means in terms of the market outlook and how long this inversion is going to last, and how deep, if stocks decide to go down, how deep that recession, that equity recession may look like. But I think it's important to take a look at historical inverted bond markets to see how it's behaved in the past and how we may expect markets to behave in the future. We hope this has been helpful. We look forward to seeing you back soon.